Marcus works from home 3 days a week. He pays $2,100 a month in rent. He has a dedicated home office, a full room, set up with a desk, 2 monitors, a printer, and a work phone. He has been working from home since 2020. Last year, his accountant asked him one question. Did your employer give you a T2200? Marcus had no idea what that was. He said no. His accountant leaned back and said, "You've left about $4,200 on the table, every single year." Marcus nearly fell off his chair. He wasn't doing anything illegal. He wasn't hiding income. He was just, like most Canadians, completely unaware that the CRA has a fully legal, fully approved mechanism that lets you deduct a portion of your rent, your utilities, your internet, and more, directly from your taxable income. It's called the Home Office Expense Deduction. And right now, millions of Canadians who work from home are not claiming it. They're handing free money back to the government every April without even knowing it. Today, we fix that. Here's exactly what we're covering. Chapter 1. Who actually qualifies? Because this isn't just for freelancers and the self-employed. Regular employees qualify too, and most don't know it. Chapter 2. The two methods. There's a simple way and a detailed way. I'll show you the math on both so you can pick the one that puts more money back in your pocket. Chapter 3. The exact expenses you can write off, and the ones the CRA will reject if you get audited. Chapter 4. The T2200, the single form that unlocks everything for employees, and why your HR department probably isn't telling you about it. Chapter 5. The self-employed advantage. If you run any kind of side hustle or business from home, the rules are even better. This is the chapter most financial videos skip entirely. And Chapter 6, the one I've been teasing, a stacking strategy that combines your home office deduction with 2 other CRA-approved write-offs to triple your refund. Stay for that one. I'm Grace from Money Glow Up. We break down Canadian money stuff so it actually makes sense. This is education, not financial advice. Talk to a professional before filing anything. Cool, let's get into it. Let's kill the biggest myth right now. Most Canadians think home office deductions are only for self-employed people. Freelancers, consultants, people with incorporated businesses. Wrong dart. Regular T4 employees, people with a regular paycheck, working for someone else's company, can claim home office expenses too. They just need to meet 3 conditions. Condition 1. You must be required by your employer to work from home. Not just allowed to. Required. This can be written into your employment contract, or your employer can confirm it on a specific CRA form we'll talk about in Chapter 4. Condition 2. You must use your home workspace more than 50% of the time for work. So if you work from home 3 days a week out of 5, that's 60%. You qualify. Condition 3. Your workspace must be used regularly and exclusively for work. This is where people get tripped up. The kitchen table where you also eat dinner doesn't count. The spare bedroom that doubles as a guest room is a gray area. A dedicated room used only for work. That's clean. That qualifies. Now, self-employed Canadians, people who file business income on their taxes, have even more flexibility. We'll cover that in Chapter 5. But the key takeaway right now is this. If you have worked from home for any portion of the year and your employer can confirm it, you almost certainly qualify, and the refund can be significant. Let me show you the math. CRA gives employees 2 ways to calculate their home office deduction. Let's walk through both. Method 1, the flat rate method. This one used to be simple. During COVID, the CRA let you claim $2 per day worked from home, up to $500 total. No receipts, no forms from your employer. Just count your days and claim it. Here's the bad news. The flat rate method ended after the 2022 tax year. It was a temporary pandemic measure. It's gone. For 2023 and every year after, employees must use the detailed method. But here's the thing. The detailed method is almost always better anyway. Let me show you why. Method 2, the detailed method. This one requires a bit more paperwork, but the numbers are dramatically larger. Here's how it works. You calculate what percentage of your home is used exclusively for work. Let's say your apartment is 800 square feet. Your home office is 120 square feet. That's 15% of your total space. Now you add up all your eligible home expenses for the year. Rent, $2,100 a month times 12 equals $25,200 a year. Utilities, heat, electricity, water. Let's say $150 a month times 12 equals $1,800. Internet, $80 a month times 12 equals $960. Total eligible expenses, $27,960. Multiply by your workspace percentage, 15%. Your deduction, $4,194. If you're in a 30% marginal tax bracket, that deduction saves you roughly $1,258 in actual tax. Not a credit, not a rebate. Real cash back from the CRA that hits your refund check. And if you're in a higher bracket, 40%, 45%, that number climbs even further. Now here's the thing that makes this even more powerful. You don't deduct this from your business income or investment income. You deduct it directly from your employment income, the income your employer already withheld tax on all year. This goes straight to the bottom line of your return. This is where people either leave money on the table or get themselves in trouble with the CRA. So let's be precise. The green light list, what employees can deduct, rent. The proportional share of your monthly rent based on your workspace percentage. This is the big one. Utilities, heat, hydro, electricity, water. The proportional share. Internet. If you use your home internet for work, and everyone who works from home does, the proportional share of your internet bill is deductible. Maintenance and minor repairs. If your home office requires painting, minor repairs, or cleaning supplies specific to the workspace, those are in. The red light list, what employees cannot deduct, mortgage interest. This is the one that catches people off guard. Employees cannot deduct mortgage interest as a home office expense. That rule applies to self-employed people only. Property taxes. Same rule, employees can't claim this. Self-employed can. Home insurance, not deductible for employees. Capital expenses, new furniture, a new desk, a new chair. Those are capital costs, not operating expenses. Different category entirely. And this is critical. Your internet and phone deductions must be proportional. You can't write off your entire $120 monthly cell phone bill just because you take work calls on it. You need to calculate the percentage used for work. Keep your receipts, keep your lease agreement, keep your utility bills. The CRA rarely audits home office claims, but when they do, documentation wins. This is the form that unlocks everything for employees, and most people have never heard of it. The T2200 is called the Declaration of Conditions of Employment. It is a one-page form that your employer fills out and signs. It confirms two things to the CRA. One, that you were required to work from home, and two, that your employer did not reimburse you for your home office expenses. That second part matters. If your employer already paid you a home office allowance, you cannot double dip and claim the deduction too. Here's the process step by step. Step 1. Download Form T2200 from the CRA website. It's free. It's one page. Step 2. Bring it to your HR department or your direct manager. Ask them to complete and sign it. This is a standard request. They are required to provide it if you meet the conditions. Most HR departments have done this dozens of times. Step 3. Keep the signed T2200 in your files. You do not send it to the CRA with your return. You keep it in case of an audit. The CRA may ask for it. You need to have it. Step 4. Fill out Form T777, the Statement of Employment Expenses. This is where you actually calculate and record your deduction. This form does get filed with your return. That's the whole process. T2200 from your employer. T777 filed with your return. Done. One more thing. If you use tax software like TurboTax, SimpleTax, or Wealth Simple Tax, these forms are built right in. The software walks you through it field by field. There's no excuse not to claim this. Okay, if you have any self-employment income, a side hustle, freelance work, a small business, consulting, content creation, anything, the rules are significantly more generous. Self-employed Canadians report their income and expenses on Form T2125, the Statement of Business Activities. And the Home Office rules on T2125 are broader than the employee rules in 3 important ways. Difference 1. Mortgage interest. Self-employed Canadians can deduct the proportional share of their mortgage interest as a business expense. Employees cannot. If your mortgage interest is $18,000 a year and your office is 15% of your home, that's $2,700 in additional deductions that employees simply don't have access to. Difference 2. Property taxes. Same logic. The self-employed can deduct the proportional share. Employees cannot. Difference 3. Home insurance. The proportional share of your home insurance premium is deductible for self-employed, not for employees. So if you are self-employed and working from home, your full deduction list looks like this: rent or mortgage interest, utilities, internet, property taxes, home insurance, maintenance and repairs, all proportional to your workspace percentage. Let's run the math on a homeowner who is self-employed. Mortgage interest, $20,000 a year. Property tax, $4,800. Utilities, $2,400. Internet, $960. Home insurance, $1,800. Total, $29,960. At a 15% workspace ratio, the deduction is $4,494. At a 40% marginal tax rate, that's $1,798 back in your pocket. And here's something most people completely miss. You don't need to run a full-time business to be considered self-employed by the CRA. If you earn any income from a side hustle, driving for a rideshare app, selling on Etsy, doing freelance writing, tutoring, dog walking, you file a T2125. And if you work on that business from a home office, you can claim these deductions. Okay, this is the chapter I've been building toward. Because the home office deduction on its own is good. But stacked with 2 other CRA-approved write-offs, it becomes genuinely powerful. Here's the 3-layer stack. Layer 1, the home office deduction. You already know this one. Let's say it generates $4,000 in deductions. At a 40% marginal rate, that's $1,600 back. Layer 2, the employment expenses for tools and supplies. Most people claiming T777 don't realize they can also deduct work-related supplies on the same form. If your employer requires you to purchase your own supplies, paper, printer ink, a specific software subscription, those costs are deductible too. Not your personal laptop, not general office furniture, but supplies consumed directly in your work. Add another $500 to $800 in deductions if you're diligent about tracking. Layer 3, the RRSP refund flywheel. Here's where it gets really interesting. Once you know what your tax refund is going to be, let's say it's $1,800 from layers 1 and 2, you make an RRSP contribution of exactly that amount before your filing deadline. That RRSP contribution creates a new deduction, which increases your refund. which you contribute to your TFSA. Tax-free growth from money that was already going back to you anyway. Let me show you the flywheel in numbers. Home office deduction generates $1,600 refund. Employment expenses generates $280 refund. You take that $1,880 and drop it into your RRSP. At a 40% marginal rate, that RRSP contribution generates another $752 refund. Total refund from the stack, $2,632. You then take that $2,632 and park it in your TFSA. It grows tax-free. You never pay CRA a dollar on those gains. This is not complicated. It is not aggressive tax planning. It is using the system exactly the way it was designed to be used. The CRA built these tools and put them in the Income Tax Act. Most Canadians just don't know they exist. Before I let you go, 5 mistakes that get people in trouble. Avoid these. Mistake 1. Claiming a shared space. The kitchen table, the living room couch, the bedroom where you sometimes open your laptop. These do not qualify. CRA requires the space to be used regularly and exclusively for work. Get a dedicated room or a dedicated sectioned-off area. Mistake 2. Forgetting to get the T2200 before your employer's year-end. HR departments get busy. If you wait until March to ask for your T2200, you might be waiting a long time. Ask in January. Ask early. Mistake 3. Using total home expenses instead of proportional ones. You cannot deduct your entire rent. You deduct your office square footage divided by total home square footage. Do that math correctly every single year. Mistake 4. Claiming capital expenses as operating expenses. Buying a new desk, new monitor, that's a capital expense. It gets depreciated differently. It does not go on your T777 as a home office expense. This is the one that triggers audits. Mistake 5. Not keeping documentation. Keep every utility bill. Keep your lease. Keep your T2200. Keep your internet invoice. You don't file these documents, but if CRA ever sends you a review letter, you need them in 30 days. A shoebox of receipts is your best friend. Here's the bottom line. If you worked from home this year, even 2 or 3 days a week, you almost certainly qualify for a deduction that could put $1,000 to $4,000 back in your pocket. Not next year. This April. The CRA is not going to call you and remind you to claim it. Your employer is not going to volunteer the T2200. Your bank is definitely not going to help you keep more of your money. That's what we're here for. If this video just saved you from leaving money on the table, share it with someone who works from home. They'll thank you at tax time. I'm Grace. This is Money Glow Up, and I'll see you in the next one.